So the big question is this: how are real estate investors who don't have a ton of free time, don't have access to off-market deals, and didn't start life on third base, how do we grow a real estate business conservatively to support our families, finally leave the corporate rat race, and build a legacy? That is the question, and this podcast will give you the answers. I'm Ed Matthews, and this is Real Estate Underground. This is the Real Estate Underground podcast, show number 82. Greetings and salutations, Real Estate Undergrounders. It's Ed Matthews with the Real Estate Underground podcast. Thank you so much for joining us today. Today is an interesting conversation. It's someone that I have been tracking on LinkedIn and a couple of other places for quite some time. I've learned quite a bit from him, and I thought that, this audience, our audience here, you folks, would get a lot out of this conversation. So with that, Axel Meierhoefer from Ideal Wealth Grower, thank you so much for joining us today. And I apologize. I think I stepped on your last name a little bit, so my apologies for that. Welcome to the show.
Yeah, thank you for having me. And it was very close, so don't worry.
Yeah, horseshoes and hand grenades, right?
Yeah, exactly.
And last names. So Axel, thank you so much for joining us. And like I said, I've been, paying attention. I listened to your podcast, as a matter of fact, and which we'll talk about in a little while. But, the thing that I wanted to have a conversation around is, obviously you are a very accomplished in terms of your background and what you've done. And now you're paying it forward with your mentorship and coaching programs. And so, one of the things that I wanted to do was kind of, for those of us out there that don't know who you are, if you could just kind of tell us a little bit about your background and how you serve your community.
Yeah, absolutely. Well, not to go too far into the history and stuff like that. I served in the military, then retired here in the US, even though I originally came over with the military from Germany. And I immediately got offered a job in a software company in the Santa Barbara area and started thinking, okay, well, would employment, the traditional way of employment, really the kind of thing that I would want to do? And I kind of tested it, I guess is the best way to point it and put it. And I kind of discovered that I'm, some people call it unemployable. It wasn't for me, let's put it that way. But that also, when I started my own business as a consulting company, it immediately brought up, okay, so how am I actually going to make sure that I don't have to work into my 80s, 90s, or however old I might make it in the end? What ways can I find that would allow me to have some sort of an end date for work?
Yep.
And that whole episode, that whole kind of situation, thought process happened around 2001, 2002, 2003.
Okay.
And anybody who can remember, that was basically the time when the so-called .com bubble burst and the stock market really, really crashed. And so for me, the point was, okay, that is not the area, because a lot of people depended and wanted to get rich quick or had a lot of money in it and were kind of approaching retirement and were devastated.
Yeah.
So I wanted to find something else. I knew I had at the time about probably 20 years ahead of me. What should it be? And I started searching around, and I tell the story quite a bit that when I was looking around, I tried to find, what do people who make a lot of money at that time do with it?
Yep.
And one of the people that popped into my head every so often around that time was Arnold Schwarzenegger, because of the movies.
Sure.
And, there was a little bit of a kinship. He came from Austria. He stayed in Germany for quite a few years before he ultimately made the jump over to the US. And so I was wondering, what does he do with all the money from the movies? And I found out he's investing that money in real estate.
True statement.
And, and so then I dug a little deeper, tried to find out if that would be something for regular people too, did courses and so forth. And the whole intention initially was purely to say, okay, I have my consulting company. I'm doing everything I can to make it successful, and I will develop a portfolio for me, for my family, to protect us and to build generational wealth. There was no real intention, to make it into a business or a mentoring program or anything like that. And I think it's pretty normal. I'm sure that happens to you too, Ed. When you make friends, you build a little bit community, and people just, when you meet them, they say, hey, what are you up to? What's going on in your life? Right. And I was the one who said, oh, I took this course about real estate. Or a little later, I said, hey, I'm the kind of guy who is in the process of buying a property and it's far away from here. People like, what? How is that going to work? Right. And so forth. So I was constantly, my friends and compadres, so to speak, they were always hearing me talking about real estate and kind of got interested. And ultimately, some people dug a little deeper and saw that this was not just for fun, but this had an actual purpose and a long-term plan and so forth. Yep. And as they saw some success, which I find in hindsight understandable, people are, I don't know if this is really something for me. Everybody says it's only for rich people, blah, blah, blah. So when they saw that stuff was actually happening, and they started to inquire more and more, they were the ones to say, hey, this, I'm interested. This is really cool. You should make it more official. You should help other people to do what you've been doing. Well, and so ultimately how would you put it? Like they broke me down or they got me, got me over the finish line, whatever. Yeah. And so that's how the whole thing basically started. And I'm right now in the process of acquiring 2 more properties. So fantastic. Even though, I've reached what we determine as the time freedom point, but that doesn't mean that you have to stop investing if you have the means and you have the interest, and interestingly enough, my consulting company is still around, is coming up on 20 years here pretty soon. Yep. And clients still want me, so I still make income that needs to be invested somewhere.
Sure. Hey, if your phone rings, you might as well answer it, right?
Yeah, exactly. Yeah.
Right.
So that's kind of the story on how this all kind of came together.
Yeah. So you're based in Southern California, and I know quite a bit about that area. I have family there. My father and stepmother live in San Clemente, not too far from you. And one of the things that we've always talked about is, me and my dad is, the how expensive real estate is. And I've got a friend out in the LA area, Andy Choi, who talks about really high end flips. Like, when we get on like a Zoom call like this, we're talking about, the flips he's doing. And when I was flipping, I no longer flip. I'm focused on multifamily, but he always remarks about, well, I bought it for 1.4 million and we're going to put 500,000 into it and sell it for 2.8. And I said, well, that's fantastic. That is 4 houses for me, maybe 5. Right. Yeah. And or more. Right. Yeah. It depends on the city, right. Or the town. So in terms of your focus, right, I'm pretty sure I heard you say that you invest outside of your geographic area.
Right.
I assume it's because of property value and returns, right? But I'd love to hear more about that. You're thinking in terms of, not only how you do it, but where you focus. Like, what are you looking for in a potential market so that that it's a good fit for your investment strategy?
Stay with us. We'll be right back. A motivated seller just filled out your web form. If you call back within 5 minutes, you're nearly 4 times more likely to get that seller appointment. But delay your follow-up by even just 10 minutes? Forget it. You're toast. Ella Vista Connect calls that lead back in 60 seconds, qualifies them, and schedules your meeting. Find out how much slow follow-up is costing you. Free calculator at ellavista.com/underground.
Okay. Yeah. So that's a little bit of a list of questions. The first thing about expensive areas, like up and down the coast in California, or if you go like New York or any kind of big metropolitan area or stuff like that. I would say if you are in the situation that you mentioned when we prepared for the show that your audience is kind of like between like mid-30s to like mid-50s. Yep. So if you find yourself like early to mid-30s and you are still by yourself or at least not married with kids and you have a good job, there is a way to make it work locally, because you could either have had military service, so you're eligible for a VA loan, which is 0 down payment, or you could go with some of the incentives that exist for first-time home buyers. Mm-hmm. So just to put this aside real quick, and then I'm going to explain why I couldn't do it and most people can't do it. But if you had that, either one of the two, And like if you go in the San Diego area and you say, okay, I'm looking for a triplex or a fourplex that I'm going to buy, and like your friend says, 1.5 million. But if you say I can get that for 3% down, right, because you get first-time home buyer support and stuff like that, that's basically like 30 and 15, so $45,000. There are probably people, especially when they have a good job and they've been somewhat frugal, that they could do $45,000
Sure.
and get that property. And then you would basically move into one of the units and renovate the other ones, rent them out when they all renovated, which typically probably takes you about a year and a half or two. You got to the 2-year point when you can actually get out of it, finally renovate the one that you're living in and get that rented out. So now you own a fourplex with probably each unit making $2,500 plus a month rent. So that is a good deal. But for most people, and this is what I mentioned when I said, to answer the question, why am I and how are we away from where we live, is I, in my military career, have moved around and bought a couple of houses in certain locations. So I had no eligibility for VA because I served officially in the German military, even though I was stationed in the US. And I couldn't get the first-time home buyer thing anymore because I had already bought and sold a couple of homes. So now the situation then is, okay, I still want to take advantage of real estate, but I can't do it because these things don't work. And I want to give one quick caveat. Even in a high expensive area, what I'm always pushing on is you first want to evaluate the performance criteria of the property, regardless where it is.
Right.
And so for us, for renovated properties, we still to this day try to get close to the 1% rule, meaning like the property costs like $150,000. We want to be able to get up to $1,500 in rent.
Right.
And any other kind of equivalent to that. Now we're also investing into build to rent, basically brand new build properties. And we're willing to go to about 0.8 on that because you can do this due to the fact that you don't need the typical 15% reserves. Just for your audience, if they're not familiar, normally we say, or I say, and I do this also for myself, from the rent, put 5% away for maintenance, put 5% away for vacancy, and put 5% away for capital expenditure, any kind of big things like new air conditioning, new roof, that kind of stuff.
Yep.
So that's 15%. But if you buy a brand new property, literally like I'm buying one right now in Memphis, that's going to finish in May, there's no expectation that the roof is going to go away anytime soon, that any major system is going to fail, that I'm going to have any significant maintenance because I have a builder's warranty and then I add another warranty insurance policy on top of it. So probably for the first 5 or 6 years, there isn't really anything major should happen. So I can save myself that and only do the 5% for vacancy. So I'm literally saving 10% or have 10% more cash flow if you want to. So theoretically, if I had that same house, 150,000, and I'm only getting like 1350 rent, that would still be okay.
Gotcha.
Because ultimately the cash flow would be the same. So build to rent, brand new house, 0.8 ideally, and renovated house, 1%. If you can better, even better. Now, if you look at that in any kind of high price area, you will find out even if you get your first time home buyer and all that good stuff, it might still not perform to those criteria. But so that's the one thing. And then obviously the next thing, and you asked me, how do you do it? How do you find the areas? The first thing that we're looking at is which fundamental metropolitan areas or communities have a good reputation as a rental community. Because as investors, we are obviously looking to rent our properties to tenants. Yep. So like one of the probably most famous ones in the country is Memphis. Sure. Right, where you oftentimes have to ask yourself, okay, like they have great rent, had it for decades. A company that was, you probably know, used to be called Memphis Invest. Now they call themselves REI Nation. I know Chris Closure. He wrote, by the way, a really good book for your audience if they ever want to get into turnkey investing. It's called Turnkey Revolution. So that's, for example, a market and similar markets like that. So you want to look first which markets are known for good, solid rent performance. Then what's the economic environment of that particular area? Is there a lot of outflow because business is leaving? Is there kind of a certain level of stability, or is there inflow, which is nice? Like Alabama, for example, right now is one of those areas. They have attracted a lot of car manufacturers, military stuff, space command, all that stuff. and the ratio is still reasonable. So that's kind of like how you fundamentally say, okay, where in the country can I actually find these locations?
Yeah.
And then for us, and this is maybe one of the little bit of the kind of special secret sauce, is that we are saying, okay, we want to be passive investors. We want to reach a time freedom point, and I can explain a little bit how that works. But that also means we probably have some other occupation, whether it's me with my consulting company, other people that have a job, far away from these investment properties. So how do we handle that? And the thing that I have basically developed, and it's not that I invented it, it became obvious to me. What we want to do is we want to work, especially for renovated properties, with turnkey providers. Mm-hmm. For a lot of people, some of your listeners too, there might be a red flag. Nobody ever should buy from them. So here's how I look at it. A turnkey provider that we would be willing to work with, and anybody who becomes a client in our organization gets basically access to my whole network of all the relationships I've built in the last 15 years. The turnkey providers that we are selecting are the ones who find what I call the ugly duckling in a good neighborhood, mm-hmm. in one of those general areas. They buy it. Let's say they buy it for $80,000, and they say this thing needs $50,000 to renovate it. They renovate it with the intention to sell it to me or you or anybody who is listening, but also knowing, and this is super, super important, that they will be the ones who manage it for you and me and whoever the buyer is.
Right.
That has a psychologically important impact on how do you do the renovation. If you know in 2 months or 3 months from now, I'm going to be the part of the team that's going to maintain this thing and manage it, right?
Yep.
So with that in mind, we only buy from turnkey providers who find it, renovate it, sell it to us, and then manage it. And oh yeah, God forbid they are allowed to make a profit, so they sell it to me for $150 instead of the $130 they put into it.
It's still America.
Well, but it's also, I think it's fair that when somebody puts out an effort that they get paid for that.
Absolutely.
The more important thing for anybody who is considering this type of investing is that the same people who renovated it, who now know the ins and outs of their property, are also the ones who are managing it.
That makes a lot of sense.
And these organizations that I'm working with, some people might think, oh, is that maybe a little mom and pop shop? But like the main turnkey providers we use, all of them have now more than 300 doors, right? So that also means they have scale. That means they can have a team of people, that have all the different trades, and you don't pay necessarily $150 just for somebody to show up and look at the faucet instead of doing something, right? All that good stuff that the horror stories you hear. So what ends up happening, and part of what I'm preaching for anybody who's joining Idea Wealth Grower, is you want to adopt a mindset that makes it very clear that you are in the business and own a business that has you as the head, and that head's title is investor.
Yes.
And as an investor, you are basically the creator of your own future, which if anybody is interested, you can download a mindset manual that I wrote for free. The other end of that same scale, if you're not the creator of your own future, you're probably at some point of victimhood. Because too many people, in my opinion, are seeing themselves life happening to them rather than actually creating and creating. So that mindset. So I have a business which is in the business of investing in real estate, and I'm the head of that business, and my title is investor. So I'm hiring property management. I'm hiring an insurance agent. I'm hiring a bank or a lender. Those kind of things. So it's the same thing like when you run any other business, you have certain people that work for you to make that business successful.
Right.
It doesn't mean that the guy at the top, Mr. Investor, is doing all the work, which is kind of getting me a little bit on my soapbox when I hear all these, now they even have some commercials on YouTube again, you don't want to get the call in the middle of the night about the toilet. Bullshit. If I'm a business owner, and I call myself, I'm the owner and investor, or you can call yourself the owner and founder of that business. These people work for you, right? Just like if you were to do any other business, you were the CEO and founder of any other business.
Right.
They will think 12 times, if not more often, if they should call you in the middle of the night, right? And so that is just one of the myths. But fundamentally, if you adopt that mindset, You build relationships with my help initially if you come to us with all these different entities. Then you can start saying, okay, now I have this. And what I'm a big fan, and then, I think I've probably answered the different layers of that question, is that you want to establish clusters.
Okay.
And what I mean by that, like I have a cluster in what's called the Quad City area, which is a little bit west of Chicago. Yep. And I have another cluster in Ohio. And now I'm, like I mentioned, Memphis area, Tennessee. Why is that? Because if you buy multiple properties from the same turnkey provider, and in my case, I'm also referring our clients to the same turnkey providers, we gain, as a group of investors, we gain power, right? Because we can say, okay, Mr. Turnkey Provider, nobody is perfect. No employee has ever been perfect, and anybody you hire into your business is necessarily perfect.
Yep. When
they screw up with something, you say, okay, owner of the turnkey company talking to owner of the investing company, what's going on here? It's important and helpful to say, this person that I'm talking to is a member of the Ideal Wealth Grower tribe, and they have 20 houses with us. Versus you're a single investor who has one property.
You're absolutely right about that. In terms of community, it does bring, it's just like, it's supply and demand, right? If you have buying power, you're going to get better terms. If you have a community that's investing in a company, then they're going to certainly pay attention when they hear that you're on the other, a member of your community is on the other line, right?
Yeah, exactly. Well, and it's no turnkey provider would want to lose 20 or 30 properties all at once, right? And so, and I mean, we never haggle with them on their price, and we never haggle with them on their property management fee. We only, if at all, haggle with them on performance. Right. And I think that's fair. Anybody who runs a business, and that's why it's so important to say you are the founder and owner and name yourself investor of your business, your investing business. And as such, if the people that you hire to work for you don't perform, you have to have a conversation at the least.
Yeah. So let's talk about that, because, obviously it sounds like, I am also I'm a recovering consultant, no longer a consultant, but I did do it for a long time. And, one of the things that, we were always focused on was, the things that get measured improve, right? And so, in terms of your systems and how you measure the performance of a property manager, for instance, what is your process in terms of that? Because obviously you're not the one knocking on doors and fixing, the 2 a.m. toilet and, painting and making ready a property before someone else moves in. So how do you do it?
Well, fundamentally, there's something called a pro forma. So when you basically go and say, okay, what are properties that the provider is offering? Provider could be a turnkey provider, could also be a flipper, or could be other people who have worked on properties, because some turnkey providers are willing to accept a property that you bought just off the market from wherever and include it into their portfolio. It's just with a little caveat that if they didn't renovate it, they will always have an excuse when something breaks. Right. So it's not when something breaks directly from the turnkey provider, they say, oh yeah, that wasn't our fault. I said, well, who fixed it?
Right.
Who put it in there? You put it in. If it breaks after a year or two, I mean, there's a reasonable period, right? Like if they put in a faucet and after 12 years, you can't bring that same argument anymore.
But 6 months down the road, you certainly can.
Yeah, exactly. So that's the thing. But back to the pro forma. So what typically happens is that anybody who wants to sell something, and the same is true for turnkey providers, they create a pro forma and they say, okay, we expect that you can get this rent. Mm-hmm. We are confident in the quality of our renovation. So even though you put your 5% maintenance fee in there, we believe in the pro forma that 2% is enough.
Yep.
Right. And so forth. So you basically study all these things. And that's basically the list of criteria that we hold them accountable for. Right. If, for example, maintenance was projected by them 2 to 3%, even though I tell myself and my clients, let's put away 5%. And it is 5 or even more %, then we have to have a conversation, right? So that would be one of the things. The other thing is most of these organizations, knowing their areas really well, can and venture to give you projections on what is the level of appreciation you can expect, both for the value of the property and for the rent. And all those are criteria to say, okay, I don't expect you to necessarily be better than you promised, but at least please keep your
But
promises.
you've got to meet the expectations that you're setting. Right. Yeah, I get it. Okay. And so, in terms of, how you operate and, the principles on which you operate, I'm curious, what are the kind of key metrics that you are paying attention to? Is it simply appreciation and profitability of the rent, return on investment, or are there other criteria that you're looking at?
Well, the criteria, I mentioned some of them already, the 1% rule and the 0.8 for new properties and so forth. But the starting point is somewhere else. The starting point is if we were to pretend, okay, Ed is interested and we have a strategy call, you signed up through the website, scheduled a call, and so now we're talking about it. What we would do either in this first strategy call, or maybe if you decide after that initial call, hey, I really want to work with Axel and at least try it for 6 months, which is, we have two options. You can say, I want to really all in, join the tribe, or you want to try it for 6 months.
Okay.
Let's say you were to say, I try it for 6 months. One of the very first things that I would basically work through with you or anybody else is, what is your current financial situation? And what is what we call your time freedom number?
Yep.
And the time freedom number is defined as the number, or meaning like the amount of money per month that you would have to get through other means other than trading time for money, meaning like having a job or running a business.
Right.
To cover all your life expenses, like your car, your food, your vacation, your house, whatever it might be.
Right.
What is that number per month? So I'm just making an example. Let's say you would have said 4,200.
Sure.
Per month. If I had 4,200 coming in, then I had the freedom, which is why we call it the time freedom.
Right.
You would have the freedom to say, do I want to do my job half-time? Do I want to do it full-time? Do I not want to do it at all? You have that freedom.
Right.
So then we say, okay, what is a realistic number in cash flow that we can assume to accomplish for our investment properties? Right. And so if we were to say, okay, I want to make $400 cash flow on an investment property, on a single family residence, then we can say, okay, with $400 and $4,200, if I'm not mistaken, we need 12, right?
Yep.
Is that about right?
That's right.
So now we know from where we are today, you and I, Ed and Axel, would start working on how do we acquire 12 properties. Now, the one thing I would tell you at the end of that first conversation, just a little secret, Ed, it's really not going to be 12.
Right.
And you would probably say, why is it not 12? And I would say, I know, Ed, you are a really, really nice guy, but even you would not let the rent be the same for the first 8 to 10 years.
Right.
So if you can make $400, and this is just a mathematical example right now, on the investment properties across the board, and that's obviously an average, that's okay. You have your first property. Year one, $400. If you're generous, you say year two, also $400. Then at the latest, you would say, okay, I increased the rent by $50.
Right.
So out of that, the vast majority, since your mortgage and most of that other stuff doesn't really increase, give a little bit more to property management, but let's say 40 of those $50 come in your pocket. So now you're at 440. Yep. Then 2 years later, if you do it every 2 years, you're at 490 and so forth, right? So as you accumulate properties, it's not just straight out 400 on each one. It will overall be more, so that in the end, at 4,200, you probably need, just from today's money and today's purchasing power, probably about 10.
Yep.
Right, instead of the 12 that math would say, just because you're increasing the rent and then the number would be higher. Now, in reality, inflation also dictates that even if 4,200 is good enough today, by the time you reach there, you probably need 6,000. Right, so that's understood too. But as far as having a plan, it's not so much exclusively what is the criteria on the individual property level, but what kind of a plan are we pursuing, which is also when we go a little bit into where are we right now in this particular economy in 2023.
Yep.
Why I said at the very beginning that we're trending a little more towards build to rent or brand newly built properties.
Yep.
Because if you get, to keep 10% more of the rent income, then that is much easier to get to your $400 a month or $350 or whatever your number is.
Right.
Then you basically have to put that aside. And yes, the money is in your account, but you're keeping it for a reason.
Right.
And one of the things, and I finished that point since you asked about criteria, there is, in this whole journey to your time freedom point, there is a pivot point. And I have found for myself and for most clients that pivot point is around 4 or 5 properties. It has a little bit to do how quickly you can actually acquire them. Mm-hmm. But if you think about, I buy a house every year, just for the sake of argument. Sure. If you get to the 5th house, and for 5 years, if you bought good houses with good criteria and good turnkey providers, the vast majority of these reserves have probably accumulated across these houses. So now you're probably sitting somewhere on $18,000, $20,000, $25,000.
Right.
And the pivot point means when you have that kind of money sitting there for your 5 properties, it makes no sense to increase that number anymore. Because not all 5 roofs will fly away and 5 air conditioning systems will need to be replaced and stuff. Yes, they might have a little stuff here and there, but especially with new build properties, it's not very likely that they have massive stuff happening. Right. So when you reach a certain number, and I always teach and mentor our clients to say, you have to find a number that you're comfortable with. For most people, myself included, somewhere between 20 and 25,000. If you know that's sitting somewhere, nowadays you can even put it in a high yield savings account and make 5% interest, or buy a T-bill or something like that and make even more interest. Right. So it's sitting there, even if there's something really major happens, I can just go to the bank or go to the thing and pay for it, no problem. So then you don't have to keep those 15% aside anymore.
Right.
So those are all a few criteria. So the pivot point is what people sometimes forget, but that's the journey, right? I try to mentor and help people to realize this journey is available to them, number one. Mm-hmm. Number two, identify and work through what is your time freedom number. Mm-hmm. And from then on, now we know the number, now we know the number of properties, now we can actually work on finding the first one, the second one, and so forth. And most of the time after the third or fourth one, most people can then pretty much go on their own. And I'm more the person in the background if something unusual happens to say, hey, I want to have another mentoring session because I have something that I've never seen before.
Yeah. So you mentioned mentor. And one of the things that I am a huge believer in is this is without a doubt a team sport, whether you're starting this and whether you're in the beginning or you're a grizzled veteran, there is always a handful of people who have kind of helped thrown an arm around you per se, and helped you. And so I'm curious, as you've kind of grown into this business, what was the best advice you ever got? And I'm curious who gave it to
you. There are a couple of things. It's not just one single thing, but I can point to a few things, like the quadrant theory from Kiyosaki. He never spoke to me directly, but that's this whole realization, that whole realization to say, are you on the left side, or are you on the right side? Are you a business owner? That whole concept. And I would combine it. There's a really nice book that I like to recommend to people. It's called The Wealthy Gardener by John Soforic.
I've heard
of it. And he wrote that for his son. But it has a lot of principles in it that basically describe how do I go from somebody who feels probably a little bit like the rabbit in front of the cobra or the snake,
right? Somebody
with confidence, with a certain level of experience. And I would say, if people ask me, what is the majority of the stuff that you do in your mentoring? Mm-hmm. It's not so much this mechanical thing and the calculations. Yes, we do that too.
Sure.
And we initially, especially, we go through evaluating properties and all that stuff. But what my majority of my work is, I want to help people to adopt the self-confident mindset of a successful business owner. And that is not just, I believe it, but I can also communicate it. When I'm in front or on a Zoom call or whatever it might be, on a phone call with property management, they recognize me as an experienced person who knows what he or she wants, who can articulate what their rules are, what they are standing for, what their principles are. And they are high level. And that's one of the things that I always use as a kind of metaphor. You want to be on eye level with these people. And as soon as that's established, you get treated totally different.
So true. Yeah.
And not being run over by a bus in a sense, because everybody thinks you're kind of like a newbie and you have no idea and stuff.
Right.
Changing that attitude, that mindset, that approach, that communication, I would say that's probably 75% of the mentoring. The other part is then, okay, here we have a property, here are the things, let's review it, let's learn how to do that. And that's why I'm saying, after the third or latest the fourth property, people have the mechanics, as I call that, down, but they're oftentimes still working, depending on personality and heritage and stuff like that, on really fully living into, I'm a business owner and I have every right as the person who runs this business to be treated accordingly.
Yeah. And, the fact is that when you are, as a real estate investor, I agree that status and, where you are level with the folks that are working for you or even your partners is very important. Right. And, the thing that I think the gap that I think you and your program fill, your mentoring program fill is, it's the, I'm trying to remember. It was Louis Pasteur who said, fortune favors the prepared mind, right? And,
yeah, absolutely. Yeah.
Right. And so, the fact is that as you learn, as you become proficient, you go from unconscious incompetence to unconscious competence, and the three levels between it, right? Your stature changes, your confidence level changes, and frankly, your language changes, right? You can speak
absolutely.
That a broker or a banker or, someone else in the industry is talking, and you understand at that level, right?
Yeah, exactly. Well, and one of the things you touched on mentoring, for me, from a definition perspective, mentoring is basically helping somebody to accomplish their goals by providing the experience of those things that work, as well as avoiding those things that don't work.
Yep.
And update it to the current time. Right. So when somebody joins us, if we're going back to this thing and we had our call and you decided I try for 6 months, then instantaneously you have access to every relationship that I have built. And that is a huge acceleration. Then saying, okay, go on Google and find out which turnkey providers exist and find some lenders and find some property managers and find some insurance companies and stuff. So that's one of the things I always say, coming to that commercial from MasterCard, that's the priceless part. Right. In the relationship, I mean, the evolution as a person, that's for me the fun part. But the access to all these existing relationships and having a totally different standing day one when you say, I'm interested in this property from this provider, knowing that there are 20 or 30 or 40 other properties that the tribe has already bought.
Yeah.
So that part that's very important to consider.
Absolutely. Yeah. It's, I tell people I'm a cheap date. I'll, if we meet for coffee, I'll tell you everything I know in the time that we're sharing that coffee. And in most cases, I'll buy the coffee. Right. And, but the thing is that the whole idea here is that you are, not only are you teaching them the language so they can speak it, how to execute, but, like me with my coffee dates and you with your mentoring program, our network is, it becomes their network as they join the community, whatever level that is, right? Whether it's
absolutely.
or formal in yours.
Yeah, and I like the analogy, right? Like if we look at, like I'm, for example, ever since I have a mobile phone, and it's always been an iPhone. And I'm thinking, if Apple can have pretty much all of their equipment made 6,000 or 7,000 miles away, then we can for sure run a business where the providers for our business are still in the same country.
Without a doubt.
So that's just something to realize when people say, well, when I'm that far away, how is that ever going to work?
Yep.
It works better than Apple getting their iPhones made in China.
Well, it's, again, going back to my history, Marshall McLuhan, right, in the Global Village. It's a lot smaller today than it was in 2007 before Steve Jobs got on that stage and introduced the iPhone in 2008, right?
Yeah, absolutely. I'm just using that a little bit as a metaphor, right?
Sure.
Yeah, we can theoretically say, okay, yeah, it's too far to drive or sometimes even too uncomfortable to fly. But as long as it's still within the same boundaries and it's still the same laws and the same rules and stuff like that, that's why it works if you learn how to run it as a business and not run it as somebody who is somehow graciously allowed to buy something.
Yeah, or you're winging it, right? And that's where business systems and, the curriculum that you provide is so important. So, Axel, I'm grateful for all the wisdom and experience you've provided today. I am curious, though, in terms of how you spend your non-real estate and non-consulting time, what do you like to do for fun?
Yeah, you could have actually maybe caught on when I mentioned John Forex book. I really love gardening.
Yeah,
I'm going to do something that I normally never do, but I put this up here in
a fledgling.
Yeah, so my wife and I bought a few litchis, and I just couldn't throw the seeds away. So I have the upcoming little lychee tree. It's only like 6 inches tall right now, but then and things like that. I mean, that bring me a lot of joy. But it's also, my wife always says, what actually are you doing other than the gardening itself? And I always have an audiobook on, almost always. And education and learning never ends. I think that is nowadays absolutely necessary. And, I love to see how nature makes something grow and have fruit, and I can go out in the garden and enjoy it and kind of at the same time learn.
Yeah, absolutely. So Axel, if someone wants to get a hold of you or learn more about your mentoring program or your podcast or anything else, what's the best way to get a hold of you?
Well, as we see here in the background, idealwealthgrower.com is basically the easiest way. Our IT guys made it. So if you just hang for like 20 seconds, it pops up and says, do you want to talk to us? And a little longer, and you get an invite to the newsletter, and another 10 seconds or so. And you can get the free mindset manual and so forth. So yeah, that's the best way, idealwealthgrower.com, and go there. And ultimately, if somebody says, I really want to kind of check something out or so, just do axel@idealwealthgrower.com and you have my email. Okay,
fantastic. Well, Axel Meierhoefer, thank you so much for your time today. It's great to finally meet you, I guess, in virtual person. And thank you for all that you do for the communities that you serve. So thank you.
Yeah, absolutely. It was a great pleasure.
Yeah, mine too. This has been the Real Estate Underground Podcast, a Clark Street Capital presentation. Thanks for joining us. If you're enjoying the show, please remember to subscribe and share it with your friends. If you'd like to learn more about Clark Street Capital and our upcoming projects, please join our investor club at clarkst.com/join. Until next time, happy investing.
This has been the Real Estate Underground. Don't forget to subscribe. It helps us grow. Until next time, Undergrounders, remember your real estate journey begins with a simple step forward. Now get to it. Bye for now.